still a couple of people joining, but just to, as I've said, welcome you to Collection Fund Network. Just following on from the meeting we had a couple of months ago, we obviously had presentations on various issues linking into business rates retention, council tax, and also the local government finance settlement. So again, today we have three presenters. So LG Futures, who are going to cover NNDR1 and business rate forecasting issues. Adrian Jenkins is going to cover the 24-25 settlement and related issues. And then Simon Horsington from Rates Plus is going to cover various issues around tax-based building. And then after, towards the end, Mike Heiser from the LGA will give a short update from the LGA's perspective on current developments. So what I'll do is start by handing over to Chris, Lee and Caroline from LG Futures for their presentation. And obviously, if there's any questions, we'll take them at the end, and there will be a separate Q&A session for the last 10 or 15 minutes at the end of the event between about 11:45 and 12 o'clock. So on that basis, I'll hand over to LG Futures colleagues. Thanks very much.
Thanks, Martin. Good morning, everybody. Very pleased to be here again at the Collection Fund Network. So thank you very much for having us. Today we're going to cover sort of some of the issues arising from NNDR1, as well as thinking about sort of some of the next steps. And hopefully once we've got through all the NNDR1s, unfortunately it'll be closed down, coming round again. So just a few kind of thoughts about the things coming up on that front. We've also got a section on appeals, which Lee's going to cover. And I think blissfully we've left Caroline free for all of your difficult questions in the chat. So please do make the most of that. However, before we get on to business rates, just a quick annual plea for council tax. Don't forget to do your council tax surplus deficit declaration. I'm sure that the majority of those on the call have got this all done and communicated already to your preceptors, because even our kind of 7 working day bailout on the 15th of January deadline has, I think, now just about finished. So that's just the annual declaration that you have to make of whether you think there's going to be a surplus or a deficit on the council tax collection fund. Picking up both your opening amount, so the difference between the estimate you made this time last year and the actual outturn, and then also your in-year position on council tax during 23/4. As it says on the slide there, this estimate must factor in your discretionary discounts and the fact that they need to be funded from the general fund. Particularly this year, I think we've got the council tax support fund amounts for which there's some grant funding that you've received in the general fund, but nonetheless you do need to make sure you get your adjustment on those. As part of our accounting support for module 1 subscribers to the collection fund suite, so module 1 is the accounting models. If you would like to send us your declaration, we will make sure those numbers are pre-filled in the accounting model for you, so that you don't have to find them again at the end of the year. So do send those through if you would like those to be filled in. So then moving on to the NNDR1, I won't dwell too long. I'm sure you're all well aware of the kind of exciting changes that the government have brought to the NNDR1 form via the Non-Domestic Rating Act. But you know, apart from that, we now seem to have kind of 2 NNDR1 forms sort of pasted next to each other. It is very much in the same kind of structure as in earlier years. So parts 1 to 3 of the form setting the budgets for 24-25, as well as showing the payments that are going to be made on the year, including the surplus deficit and the Section 31 grants on account. And part 4. Showing your in-year forecast for 23-24, as well as the brought forward balance. So effectively the difference between what you thought this time last year and what actually happened come the accounts. Today we're not going to talk too much about parts 1 to 3 because they're pretty much factual entries from the revenue system. It's only worth saying in passing that in our experience so far, and I think we've seen about 50 NNDR1s so far. The majority of authorities have got that software update in and have been able to disaggregate the data, so to fill in all of those new columns on the form. It is worth doing that because the form does allocate you less Section 31 grant on account if you don't do that disaggregation, which is something that we've been talking about as part of our Module 3 NNDR1 reviews. So as part of that review, you'll see how much we estimate that it is costing you, or how much that we estimate that it would have cost you if you'd used the workaround instead of completing the disaggregation. That said, there are a few areas of judgment on parts 1 to 3 of the form. So we have the NNDR1 estimated growth and decline lines. So that's not just for gross rates, but it's also for the reliefs, including the funded reliefs. However, it is worth noting that on the funded reliefs, if you use that estimated growth or decline line, it doesn't usually generate a Section 31 grant change. So it is worth, if you do want to forecast more Section 31 funded reliefs and you do want to receive Section 31 grant on account as a result, it is worth allocating those out to the lines that you think they'll go into. Otherwise, the key judgment areas are the appeals, which Lee's going to talk about shortly, and also bad debts. And basically for bad debts, for parts 1 to 3, the question that the form is asking you is how much are you ultimately going to write off? So you're going to raise those bills for 24/5. You or your revenues colleagues are going to, I'm sure, very diligently try and collect those funds for a number of years. And it's a question of how much you will ultimately need to write off. So what's the lifetime collection of those debts going to be? Finally, there's the part 4, and the part 4, importantly, if you use our Module 2 monitoring model, that will give you all of the entries that you need to reflect your monitoring in part 4 of the form. I think we do tend to find that part 4 is a really difficult form to fill in. It doesn't look like the other forms that you do for business rates. It doesn't look like the NNDR1, parts 1 to 3. It doesn't look like the NNDR3. It's this very summarized format, which can make it quite tricky to get the relevant numbers. So what we thought is that it would be helpful just to talk about the key entries that go into, or in fact, all of the entries that go into part 4. The first section is shown here on the slide. So these are the ones that should come directly from the NNDR1 or the NNDR3 last year. So these are showing the amount of precepts that you're paying out in year, the cost of collection allowance that you're paying to yourself, and the amount that you're either collecting in respect of a prior year's deficit that was shown this time last year on the form, or which is being dispersed in respect of a prior year's surplus. The only number on here that we would expect might change is the NNDR3 figure, the opening collection fund balance. And that could change if you've made any changes to your accounts which have not yet been reflected in the NNDR3 data that's held by DLUC. So generally, that's the one that we expect might change, and it is important if you've made changes to your accounts that opening collection fund balance gets updated to reflect it. You can see I've picked a very boring example for the slide, which just shows all of those figures being entered correctly, so nothing popping up as needing review on here. The other entries on part 4 are showing your forecast of the amount that's going to go through the collection fund in 23/24. So the first line, and these are made up numbers, by the way. The first line on here, line 2, effectively is your net rates payable amount. So effectively, that's the amount you're trying to collect from ratepayers. In this example, there's a £1 million surplus that's being shown. But equally, it might be that you've got other, you've got a different movement in there, or it might even be that you want to report on budget for that amount. We've then got the lines for the bad debt provision and other write-offs. So if you're writing off amounts in excess of the bad debt provision, either because you didn't have enough provision or because for whatever reason you've chosen that those amounts shouldn't go to the bad debt provision, then you need a figure in line 3. So line 3 is for any write-offs which are not going to the bad debt provision and which will therefore hit the collection fund in the year. I think generally most common for that line to be 0. We've then on line 4 got the changes in year to the allowance for non-collection. So in this example, this authority on the NNDR1 Part 3 this time last year had budgeted to put 1.9 million in the provision. But what they're showing in this made up forecast is that they're actually going to release £1 million of provision. One of the key sort of questions and things that sometimes goes wrong here is people think they've put money in the provision at NNDR1 last year. You haven't. The NNDR1 last year was simply the amount that you had budgeted to put in the provision. So if you want to put in the amount that you said you were going to put in at NNDR1, then that's the figure you need to enter here. So your NNDR1 part 3 last year did not make any adjustments to your provisions. You only make provision adjustments on the NNDR3 and you forecast them in part 4 of the NNDR1 where we're here. So effectively in this example, there was a 1.9 million budgeted contribution, but actually we've got £1 million release. So in terms of the variances, that will be a £2.9 million swing for this authority against their budgets. We've then got the 2 lines for appeals. So we've got amounts charged against the provision. Obviously, the figure in here should be less than your opening provision because you can't charge more to the provision than there is in there in the first place. And we've then got the changes line. And for both of these lines, they're not split out into the different provisions. So you might be charging amounts against your provision for 2010 or 2017, and your contributions could relate to your 2010 list provision, your 2017 list provision, and your 2023 list provision. It's only at the end of 23-24 that we'll have a 2023 list provision because it's the first year of the list. So anything that you might think you've lost to check challenge appeal during 23-24 just reduces your in-year amount. You haven't got a provision you can charge that against because we don't make a 2023 list provision until the end of 23-4. The other lines on here are the transitional protection payments. So these are reflecting the amount of money which you're going to receive from the government for your transitional protection. So it should just be the opposite of the amount of transitional relief that you've awarded. So again, in this example, the budget was that they were going to award £4.2 million of transitional relief. So the 96 million or the 96.9 million shown on the first line, the net rates payable, was depressed by that 4.2 million of transitional relief that they'd expected to award. In practice, and so they get that money back as a transitional protection payment. In practice, as you can see, they've awarded less relief in these example numbers. So they're only going to receive 3 million of transitional protection payment to refund them for the cost of the actual amount that they've awarded. Finally, the other 2 lines relate to the other elements of the collection fund movements. So if you've got variances on your amounts that you're retaining from a designated area, anything you're retaining for renewables or any legal costs, then those variances would go in these lines. And I think it is a bit funny on this form. It's got so few lines, and yet some of them are doubled up because they wanted to have a credit section and a debit section. So we have this kind of odd situation on this return where the whole of net rates payable just goes in one line, which is, probably 30 or 40 different lines of things making that up. But then we've got 2 lines depending on whether your transitional protection payments are to or from government. We've got 2 lines depending on whether you've got a surplus that you're dispersing or a deficit that you're recovering. And we've got 2 lines for these year-end reconciliation amounts on these other elements, so a debit line and a credit line. So it is a bit particularly sort of strange, I think, in this very summarised form that they do double up these lines, which are actually kind of pretty tangential in general to the overall amount that you're showing. That brings us to appeals, and I'm going to pass over to Lee for this bit. Thank you.
Thank you, Chris. Good morning, everybody. I won't take too much of your time. I just thought it would be useful if we had just a brief sort of overview of appeals, given it's a decision that a lot of you are still to make on your NNDR1 at the moment, and also some context as to what's happened before, just to help you inform that decision. So if we just sort of retrace our steps and think about what the closing position was on appeals provisions as of the NNDR3, which seems a long time ago now. So overall, for the local share, so just the local government share, there was 2 billion nearly set aside for appeals at the end of 23. And of that amount, the vast majority, of course, would have been on the 17 list. There's still 233 million on the 10 list. Some authorities having nothing at all, but there's still a significant amount overall. And then for the 17 list, there was 1.8 billion. So the way we view the appeals provision is we try and sort of reconcile it with the number of years it's supposed to cover. So at the start of the end of 21-2, for example, then there was 1.8 billion set aside, and that would have covered obviously 5 years worth of appeals if they were backdated to the start of the list. It's a simplistic assumption, but it gives us a good guide, and that obviously means there was 360 million aside per annum equivalent. And at the end of 23, the figure still stayed at 1.8, but of course it has to cover 6 years worth of successful appeals now in sort of simplistic terms. So it's gone down to 300, which is exactly what you would imagine, because obviously there's an extra year's refund, but at the same time appeals have been settled during the year. Just to give you a sense of the sort of split on that 2 billion, and I will apologise, Chris has already told me off on the quality of these charts. So there's some authorities with close to over 30% net rates payable plus funded reliefs equivalent set aside for appeals, whereas there's some with the wrong sign. I won't go into saying which sign that is because Caroline will tell me off. But effectively, there's some there at nearly close to 0% for appeals. So they feel they haven't got an appeals risk on either the 10 or the 17 list, whereas others believe they need, for argument's sake, if you've got 30% of net rates payable set aside, you believe you've got potential to lose 5% of your business rates base and refund those appeals 6 years, and you'll still have enough. And the average overall for England is 12%. So that is the equivalent, obviously, of a 2% appeals loss per annum. Moving on. Chris, are we, there we go. Sorry, it's me, not Chris. Right, so moving on. If we have a look what people said they were going to set aside this time last year. So if we think about this time last year, you were being asked to fill in a form to say how much are we going to lose on the 23 list for 23-4. And the overall amount set aside was 1 billion. And of that, the average was around 3.5% of net rates payable plus funded reliefs, which compares, it's very similar to the allowance of the 3.2 that was put within the multiplier. And obviously that's the equivalent, as it were, to the 4.7 that was on the 2017 list. But whilst the 3.5 average was set aside, there's some very high and low amounts for individual authorities with, as it says on the slide there, 17 authorities with less than 1% of net rates payable plus funded reliefs, whereas there was 14 authorities with over double the national allowance and one as high as over 11%. So some very different attitudes towards how much authorities think they're going to lose in the future on the 23 list. And we'll come back to how they might have arrived at those different amounts. So obviously, as you're completing your form now, you are hoping for maybe a bit more information about the 23 list to help you inform what you're going to have to do now, which is make 2 decisions on appeals, which we'll come back to. But just for sort of a context, on the 17 list, there were 850,000 checks in total and 180,000 challenges. But if we look at how they came through, So yes, it was a new scheme, and yes, there were some IT issues, and yes, people were still focused on the 10 list. So if we look at how the checks came through over the lifetime of the 6 years, well, nothing came through until the June of 17, and there was typically less than 10,000 over the first few months per month. But then we have the spike for COVID-related appeals in the middle of the list. But as you can see, generally it's around 20,000 per month aside from that spike. And then we see that sharp increase towards the end of the list where people had that one last opportunity to appeal. So we see of the 850,000 checks that came through, 133 came through in the last 3 months of the list, which doesn't sort of bode well for having a lot of data to base your new 23 list appeals on. And there's a very similar pattern, of course, for challenges, where of the 180,000, 26,500 came through in the last few months, and very few obviously came through initially. And of course, we're seeing that same pattern again. So obviously, aside from the sort of knee-jerk reaction of businesses in terms of appealing maybe straight away, we're seeing very, very few come through. So as of September, only 31,000 checks have been put through, of which 12,000 outstanding now. And in terms of challenges, 2,500, and there's still 2,000 outstanding now. So there's very little actual information for authorities to base their 23 appeals list on, and therefore effectively I believe you're more or less in the same position you were this time last year in terms of information, and you're just having to take another sort of estimate as to what you think you're going to lose going forward. In terms of how you make that estimate, there seems to be a variety of ways, and we've not covered them all here, but these tend to be the main ones. So some authorities use the allowance that DULOC included in the multiplier at 3.2. Some will use their own local percentage. It might be a variance on the 3.2 where they feel they've historically had higher or lower successful appeals against them. There's some unfortunate authorities that have some very large sites on their list, and they make sort of a manual adjustment for the appeals against those particular sites, whether they're sort of power stations, for example. Some authorities use an external provider, such as Analyze Local, or there are others on the market, of course. And some use Analyze Local, but then change the Analyze Local figures to reflect what they believe is a more realistic figure. So some use a pure figure and some adapt it, and some largely don't provide at all. And that's probably reflecting when I showed how much some authorities are still applying for the 17 list at very little. Some just paid out of net rates payable each year. There's obviously variations on those 6 approaches, and one of the key factors actually is what you apply your percentage on. So we tend to use net rates payable plus funded release because it's a reflection on what would actually have to be refunded. But there's some authorities that will use a percentage on RV, on gross rates, or just on net rates payable on its own as well. So it's sometimes interesting across a single county area where they think they're being consistent, but everyone's using a different denominator, as it were, and they have very different appeals provisions, of course, as a consequence. So just sort of reflecting, sort of going forward then on what you've got to fill in on the form. So if we think about the NNDR1, as Chris has so well set out, in part 4, you're going to have to make some assumptions on your appeals provision. So first of all, you're going to have to decide how much you're going to adjust the 17 and 10 provision by. Are you going to release any of that provision on part 4? You've then got to decide how much of that amount you put in part 3, line 3 last year, you're going to continue to set aside. So, on the example, if you put 2 million in last year, are you going to say we're still going to hold at that 2 million? And then on part 3 of the form, you've got that same decision to make. And what I'd probably look to see is and what we're challenging authorities on at the moment is, well, if you put 2 million in part 4, you still believe you're going to lose 2 million on the 23 list. Why aren't you putting an equivalent amount in part 3 for the 23 list? Because most appeals you'd think at the moment, aside from some very new entrants on the list, are going to reflect back 2 years worth of refunds. So you would think that what you're putting aside in part 4 is going to be similar to that on part 3. And similarly, I think also being accurate now will avoid those unnecessary deficits or surpluses at NNDR 3. So if you do put those right amounts in part 4 for saying how much you're going to adjust your 17 list by and your 23 list, how much you want to put aside, when you actually come to complete NNDR 3, unless something materially has changed between now and March, you'll end up putting the same amounts in there and hopefully avoid creating a surplus or deficit now, which obviously has a timing issue for your 4-5 general fund, which will then reverse out and hit the 5-6 general fund. So, and just really, just as an observation in terms of what we're seeing on the forms, finally, so typically I would say authorities on the 23 list are putting aside between 1 and 3.5% of their net rates payable plus funded reliefs. But in terms of what that evidence base is, most are just using the figure they used last year, or they're using information they've received from their external agents. But you know, there are authorities we've come across with that sort of mismatch between part 4 and part 3 as well, and we're just sort of trying to iron those out for them. If anybody does have any questions on their part 4 or on the NNDR1 more sort of generally, they're always welcome to send them through to us if they're looking for a bit of help. I think that's my last slide, is it, Chris? I'll pass over back to you.
Thanks, Lee. So that brings us back to the budget and the impacts of particularly the NNDR1. So you'll see on the slide one of our medium-term revenue resources model extracts, where I've very unsubtly coloured in yellow the figures that get updated by the NNDR1 form. So all of your 24/5 budget figures, and in terms of our modelling, your NNDR1 actual figures would replace these, or what's shown on here, which is estimated figures purely based on inflating the prior year. So you've got those that will need to go in and be reflected in your budgets. And you've also got your 23/4 in-year surplus deficit, which is going to come from the form on part 4. The other thing that's flagged on this slide is the revaluation adjustment for the top-up or tariff. So the final adjustments for revaluation were confirmed in the 24/5 settlement. And in your accounts, those will need to end up being pushed back into 23/4 as shown here. In cash, however, that adjustment will be paid or collected alongside the 24/5 top-up or tariff. So for this authority, although the accounts figures are going to show a top-up in 24/5 of 22.8 million, in practice that will be reduced in the cash payment by this settlement of the revaluation adjustment. There's one other thing on here to highlight, which is just a reminder that if you've got any renewables, then you do want to make sure that these get included on your NNDR1 form, so that you're getting those in your budgets. It is really worth looking for those, given that you get to retain 100% of them, and they're also expected to be outside of any reset of the business rates retention system. On the topic of resets, our figures at the moment are showing the reset in 25/26. That's the earliest that a reset could possibly be, because the government have confirmed that it won't be in 24/5, but they've made no announcement otherwise. I think in practice, we won't really have a better update until we get a new government post a general election. Although I suspect that it would be a really big challenge to actually design and implement a reset for 25/26. So probably more likely that it's a bit later still. Another quick reminder is around the settlement figures versus your NNDR1. So our strong suggestion would be that you budget for the NNDR1 figures once they are done. This is because the settlement figures don't include any growth or decline that might have occurred in your business rates tax base. They don't include the Section 31 grants for policy changes such as the funded reliefs. And so they are very unlikely to match between your settlement figures and your NNDR1. You do, however, need to make sure that you include the adjustment for the top-up or tariff. So this is the multiplier cap compensation adjustment to the top-up or tariff, because that's not shown on the NNDR1. So if you're a tariff authority and you just budget for the Section 31 number from the NNDR1 form, you will have overstated the Section 31 grant, and vice versa for a top-up authority. So do remember to pick that one up as well. On the subject of the multiplier cap adjustment, we have just earlier this week issued a briefing about that multiplier cap adjustment. The settlement confirmed the blended inflation percentage that the government expects authorities to receive on their business rates income. So there's an example here which shows the authority's baseline funding level going up by 4%. The expectation and the way the multiplier cap adjustment has worked in earlier years is that that ensures that your top-up or tariff rises by the inflation percentage that should have been applied, i.e. the increase in the multiplier. So for this year, that's 6.6. And for this example authority, the top-up adjustment should make the top-up movement up to 6.6%. In practice, what we found is that the formula included in the NNDR1 guidance doesn't appear to deliver that additional inflation. It appears to be slightly short. And that's what our briefing covers. There's quite a lot of detail in there about the calculations that we've done to try and review the figures that were provided as part of the settlement and to try and see where we think they differ. We're hoping that there'll be some clarification shortly on the methodology, on the government's policy intention, whether there is actually a change in policy intention that's reflected by these numbers, and also on the amounts that they're actually planning to pay and collect from you in terms of this adjustment. Usually those actual figures don't get confirmed until the Section 31 payment schedule is issued for the following year. So usually that's I think probably February, March time once the NNDR1 data is done. But hopefully, given that there's this question about how much resources authorities are actually going to have, we're hoping that we'll get some clarification on that soon. So to conclude, council tax declarations, hopefully these are done, dusted, signed, sealed and delivered already. But do try and get onto that if it hasn't been. Business rates, a challenge to get the NNDR1 form done, all of that information required, plus all of those judgments that you need to make. We do have some capacity to assist more authorities with the NNDR1. So if that's something that you would like some help with, please do get in touch. That support could include the monitoring, so looking at the 23.4 position to try and assess what your Part 4 should look like. Once the NNDR1 is completed, do send it through to us and we can get your medium-term revenue resources model updated to reflect the contents of the form, so getting those resource projections updated. Obviously important then that your medium-term financial plan reflects what the NNDR1 is telling you about movements in your tax base and the ongoing position. As I mentioned at the beginning, it's then, I think, going to, for the majority, be straight into close down prep. So as I've shown here on the slide, so our plans to support you with that involve the close down preparation webinar in February. That's planned for the 8th of February. We'll be getting the booking details out for that soon for subscribers. March, even more preparation. So we'll be looking to make sure that we've got all your purchase orders, got your confirmations around the subscription. That will allow us to issue the Module 1 accounting models in good time for year end for you. We'll also have our usual training webinars during March on those models. And then finally, April, we'll be into close down. So hopefully by then, We'll have all the data on 24-25, which will enable us to have updated the MTRR for those key data publications, so the NMDR1 and the council tax requirement, and of course the final settlement as well. And also we'll have the monitoring models hopefully ready for 24-25, reflecting all of those new columns and all of that lovely disaggregation that will be needed for 24-5. Looking a bit further into the summer, we're hopefully looking forward to seeing some of you at the IRRB Spring Conference in hopefully sunny Milton Keynes I think that's in May. And then shortly afterwards, I suspect we'll have our local taxation benchmarking reports that will come out. So usually for those, we're waiting for the collection rate data for the prior year to be published, and then we can get those reports out during the summer. But as I say, rather a lot to get through before then. But do get in touch if you have any questions or if you need any support with any of that. We will of course make sure the slides go across to be circulated. And I think, although I think Lee's got some NMDR1 reviews that he needs to get to, but Caroline and I will be around for the rest of the session for any questions. So thanks very much for having us, and we'll look forward to seeing you next time, hopefully, if not before.
Okay, thanks very much, Chris, Caroline and Lee. Wasn't sure if anyone had any questions at this stage which you're quite happy to put in the chat, or if not, then we can pick them up at the later Q&A session towards the end of the meeting. I don't see anything at this stage, unless Jamie, there's anything you see in the chat. So on that basis, we'll move ahead to the next presentation, which is by Adrian Jenkins from Pixel on the 24-25 settlement. So I'll hand over to Adrian.
That's great. Thanks very much, Martin. And good morning to everybody. Today we're going to look at the provisional settlement to some degree. I know we've probably been over that quite a bit in recent events, and you spent time looking at it. So we'll look ahead towards the final settlement as well, which is imminent, and some of the latest reporting on potentially additional funding that might come out around the final settlement, and then sort of lift our eyes towards the horizon a little bit more and think about the medium term, think about what the fiscal position looks like for the budget later, well, in March this year, and then over the medium term, what that might mean for 25, 26, 26, 27 and beyond. So just sort of setting where we are now in the provisional final settlements in the sort of the wider context of what the government's public finances look like and what that might mean following the general election later this year. So just quickly to recap before we look at the final settlement, just to remind ourselves that core spending power increased by 6.5% in cash terms in the 24-25 settlement that was announced just before Christmas. I think a really big issue for authorities is what does that mean? Is that real terms growth? We know the cash terms increases, the cash terms increase, but what does that mean in real terms? So CPI was around 4.7% at the time that the settlement was announced. It's dropped down now to about 4% and is likely to be around 3.6% for the period of 24-25. That is, in that sense, that narrow sense, that's a real terms increase of maybe just over 2% per year. The GDP deflator tends to be a bit lower than the headline CPI rate. So in 2023, that was about 7%, and is forecast to be, more like 2.3% or 1.7% in 2025. So on that basis, a larger real terms increase. But of course, another way of looking at it is that your planned spending, certainly if you're an upper tier authority, adult social care, planned spending was up 13% in the current year, 13.6% in children's services, and we're seeing some reporting that homelessness pressures are more like 25% increases, so that's affecting district councils as well. So pressures on spending quite in excess of the cash terms increase in core spending power, and I think that's what's led to there being pressure on the government to find more money for 24-25.
So I'm not sure if we've lost Adrian there, or unless it's my connection.
Oh, I can't hear
I
him
think it's
either,
the same for
Martin.
me, Martin.
Yeah, I was just double checking in case it was my Wi-Fi that had gone down. So I suggest we sort of pause for a couple of minutes and then wait for Adrian to hopefully log back in again, because we did have one or two login issues earlier. So if you just bear with us, so perhaps we can just take an early 5-minute break for coffee. It looks like Adrian's back again, so
Yeah,
I'll hand
not quite
over.
sure what happened there, Martin. I could see you and hear you, but I think I was just booted out from the.
Well, I was a bit worried the
camera
power
mic.
had gone off again in Cumbria, but sounds like it's okay now.
We're
So
still there. We're still there.
Okay.
I'll carry on.
okay,
Jamie, you'll need to give me share permission again, because I've lost the share permission. I'll just carry on.
Sorry, I'm just trying to figure it out. Carry
I'll
on,
just-
and I'll try
carry
and
on
figure it out in the background.
I mean, I think that's why I've entitled this next slide. They think it's all over, because I think we are now looking at an increase in funding in the final settlement. Usually there's almost no change at all between provisional and final settlements. The movements are very small, but sometimes you do get pressure from MPs that forces a government to find more money. A few examples: in 2013-14, there was additional funding for rural authorities. In 2016-17, they brought in a transition grant, £150 million in each of 16-17 and 17-18. So the amounts have been fairly small when there has been a lot of pressure from MPs. So what might we expect in 24-25? I know when I speak to some people, they say they're expecting around an additional billion. I think that's probably a bit too high. I think what we're looking at probably is something more like 500 million. And I know just as we came into today's session, LGC were reporting that there'll be an extra £500 million for social care funding in 2024-25. So that's a very live issue that we need to keep an eye on. But I think we should expect there will be an increase in funding in the final settlement. It's been brought about by a letter from what was 43 Conservative MPs to the Prime Minister and Secretary of State. I think it's gone up to 46 Conservative MPs now. That was from the county all-party parliamentary group under the aegis of the County
Adrian,
Councils
you
Network.
should be able to present now.
That's brilliant, thank you. So I think they're putting a lot of pressure on ministers to find more money, and it looks like that will be successful. How much and where that funding goes to, we don't know, but that's one to really keep an eye on over the next couple of weeks. When might the final settlement be? We're expecting an announcement of the final settlement numbers in the week beginning the 5th of February. The final settlements between the 4th and 7th of February in all but one of the last 6 years, and that was an exception where we had a, in quotes, early settlement a week early, and the final settlement was a week earlier as well. But it looks pretty likely that, based on past performance, that the final settlement will be in the week beginning the 5th of February. The reporting, this is from a day or so ago, that the Chancellor and Number 10 were waiting for the spring budget before announcing more money. But I think what that really means is combination of what's the pressure from MPs, plus they will know what the OBR's projections are this week for the March budget, so they should be able to make an announcement, if not now, then at least signal it in time for the final settlement in a week or two's time. So casting our minds back to the provisional settlement itself and the headlines at that time, it was effectively the second of a 2-year settlement, and we had quite a lot of advance notice of what would be in the settlement itself, from the autumn statement in November, the policy statement in early December, and then the response to the technical consultation in mid-December. So we had some advance notice, and we knew an awful lot about what was going to be in the settlement, but there were still some things that were uncertain and that made it difficult around the edges to work out what was going to be in the settlement. It continues that series of real terms increases in core spending power that we looked at in that first slide, but as I said, it doesn't really necessarily feel that way for individual local authorities. And I think the message that one message we need to get over from today is that that's going to be less generous from 25-26 onwards. So we're at the end of a period of relatively generous, and I put that in quotes, settlements. Things are not going to be as generous from 25-26 onwards. Core spending power increases are higher for social care authorities, but the the difference between what shire districts and fire authorities are getting in 24-25 and compared to those social care authorities is smaller than it was in 23-24. We'll look at that in a couple of charts later on. And that only surprise was in the services grant, which was cut more heavily than was advertised, and I think was a little bit disappointed that they hadn't been clearer about what their intentions were around services grant. Although, if the reports from today are accurate and there's an extra £500 million in the settlement, that's effectively being put back into the settlement, albeit going into social care and children's services. And as we'll see, the settlement's much less redistributive or progressive than its recent predecessors, and that's because council tax does much more of the heavy lifting in 2024-25 than it did. There are lower grant increases, which tend to be more progressive, and the 3% funding guarantee now helps lots of high tax-based councils rather than high need authorities, so it's becoming less redistributive. Quick run through some of the highlights in the core spending power for 24-25. Increases in SFA and cap compensation broadly in line with the headline rate of CPI 6.62%, although we'll discuss some of the analysis that LGF have done around whether that actually matches expectations. But broadly speaking, the increase in SFA plus cap compensation matches consumer price index uplifts. But over £2 billion worth of the notional increase in core spending power now comes from council tax. So that's over half of the increase in core spending power is now generated by council tax. And that's where we've seen, I think, quite a lot of difficulties in managing the settlement. So much of the increase in resource now comes from council tax. And of course, as we know, that's very unevenly distributed across the country. So we're starting to get the settlement creaking at the seams somewhat because council tax is now so dominant. And as we look further forward, the predominance of council tax within the local government funding system makes it more difficult to do a reset, to do a fair funding review and to manage council tax and council tax equalisation within that reset. We also had that second year of that really large increase in funding for social care that came about as a result of the government deciding to postpone the social care charging reforms. So some big increases there in funding again for social care authorities. A couple of points there. One is that a lot of us, quite a few authorities have asked whether we think that funding will disappear if a future government decides to bring in social care charging again. And my view is that that funding that you're getting in 24-25 it effectively forms the baseline for future funding. I can't see any situation where a future government would start to take that money away from you. And if it did decide to do social care charging in future years, I think it would need to bring in new funding to fund those charging reforms. Interested to see what Mike would say about that, and Lee and LGF as well, what their assumptions would be. But ours is very strongly that that funding for social care is now your baseline for 25-26, rather than at risk for future cuts or transferring into charging reforms. Then we had that big reduction in the services grant, down by over 400 million. That was a big surprise, as we've mentioned, and that really did make it difficult for quite a number of authorities in terms of their budget planning. You know, for some larger authorities, the reduction in services grant was sort of £5, £6, £7 million could be quite significant and was quite destabilising. So some core spending power principles that are worth exploring a bit further. That increased reliance on council tax increases that we talked about. So over half the increase in core spending power is now from council tax. So it's 59% compared to only 45% in 23-24. And so that changes how the core spending power increases are distributed, makes them flatter, makes them less redistributive. So it was a fairly stable settlement, but it was a flatter distribution than in 23-24. We talked about SFA and cap compensation going up in line with CPI. No new funding for adult social care, but that second year of increases from the autumn statement in 2022. We talked about services grant, another year of new homes bonus. So no change in the overall new homes bonus. That was just a quirk of the numbers. There were some large movements at local authority level. So a further year, which is it wasn't particularly well signposted, but reading between the lines, that was always a very, very strong possibility. I think many authorities now will be looking forward to 25-26. Will there be a further year of New Homes bonus? And I think on reflection, our view is that there will be. We don't have that in our model yet, but I think that's a change that we're going to make over the next month or so, putting in that option for another further, potentially final year of New Homes bonus in 25-26. Given that there isn't going to be much time between the general election and the provisional settlement for 25-26, I think that's pretty much not a racing certainty, but a very high chance that we'll get one further year of New Homes bonus. The 3% funding guarantee has helped some authorities, especially shire districts and fire authorities. In our view, it's a very poorly designed funding system because it doesn't allow the funding changes to flow through to individual authorities. It effectively underwrites any change in New Homes bonus for shire districts and for some authorities as well. So it's not a great system. It's not very well designed, and it kind of shows that the settlement process is really creaking at the seams. Looking ahead to 25-26, I'd imagine if there is a rollover settlement in 25-26, then we're looking at something similar to the funding guarantee, but I can't see it being set at 3% again if the overall core spending power for a local government in 25-26 is lower than it is now. If it's more like 4 or 5% rather than 6%, 6.5%, I can't see there being a 3% funding guarantee in there. We're looking at something lower, maybe even down to 0. So let's look at a few of those issues in a bit more depth. The first one is looking at that core spending power distribution, starting off with 23-24. So you can see on the left-hand side of this chart, the higher increases in core spending power for authorities with social care responsibilities. And on the right-hand side, much smaller increases for shire districts and for fire authorities. That just shows you that on the left, those authorities with social care responsibility getting bigger increases in social care grants in 23-24, and also the 5% increase in Band D. Similar increases on the right hand side in 24-25 for districts, but much smaller relative increases for social care authorities in 24-25. That's really clear from the chart here, and most of that is around the fact that the social care grants are just not increasing as quickly in 24-25 as they were in 23-24. Still good increases, still strong increases, but just not as big as they were in 2023-24. So flatter in terms of that distribution between social care authorities and districts and fire authorities. Also less progressive as well. It's a good chart here from the IFS showing you that the local authorities split into deciles for how least and most deprived, and you can see there that the increases in core spending power for those authorities, this is upper tier authorities, very similar right the way across the board. Potentially marginally higher average increases for the most deprived authorities, but pretty much flat. Deprived authorities not particularly getting much more than the least deprived authorities. So I think some representative groups, particularly someone like Sagoma, who made some comments, some quotes here from their response, they're very disappointed with the settlement, that it's moved away from using needs as a way of distributing funding, or the primary way of distributing funding, as an increased reliance on council tax, and very little recognition of the varying ability of different types of authorities to raise revenue from council tax. And from their point of view, from Sagoma's point of view, not delivering on levelling up. I just want to quickly touch on council tax Band D thresholds. No change in the core principles, 2.99% as the core increase, a further 2% for the social care precepts as well. And I think that 3+2 metric is probably the right one to take forward into your budget plans for 25-26 and beyond. But you know, it's not absolutely definite. I think that's just a good policy assumption to make. But I think for shire districts, the £5 threshold is now becoming a little bit outdated. Few shire districts will benefit from that £5 threshold, and I think a lot will now. Well, I know that DCN and district councils are really pushing for that threshold to be increased to £10. For fire authorities, losing even that £5 threshold, and that gave additional flexibility to lots of fire authorities. So that's unfortunate that that was removed. And I think those two elements are something that I think that will need to be considered in future settlements. I don't want to touch too much on the decoupling of the multipliers. I mean, we've modelled that through our system, our model now, and the way the numbers work, they flow through the modelling in a fairly, I wouldn't say straightforward way, but you can see how the numbers work their way through the system. Our view is that the methodology is fair and reasonable. I've seen that LG Futures have issued a briefing note earlier, I think it was yesterday, and I'd be interested to look at that and see the points that Lee and colleagues are making around the methodology and how that may or may not be fair and reasonable. Our view was that the approach that's been taken is fair and reasonable. It reflects the fact that authorities raise revenues from the two multipliers in different proportions. The table on the right hand side there shows you the indexation factors, the blended indexation factors based on the fact that authorities are raising different amounts from the standard multiplier and the small multiplier. Having looked at this chart, this table again, I can see here that instead of the 6.62% that was advertised, our table here was showing an increase of 6.53% for Ada, 6.42% for Westminster. So I suppose on the face of it, our numbers backing up what LGF is saying there. I guess the issue is whether the materiality is of what the government's done in terms of compensating authorities for that blended rate. So I'd be interested to see what LGF have done, and interested to see what the response would be from officials about that, what appears to be a shortfall in the funding that we're getting for the blended, for decoupling the multiplier. Social care grants continue to be increased, as I mentioned, and I think that's something that we need to look at for the future, but big increases there, and we'd expect that to continue into future years as well. Our view is that for 25-26, we're looking at a further increase of at least £500 million. Our view is that it's fairly unreasonable to assume that a future government won't be increasing funding for social care in the future. We talked about the funding guarantee continued at a slightly higher level in 24-25 than the current year. Most of the beneficiaries of the 3% funding guarantee are district councils, and certainly in terms of the share of core spending power that comes from funding guarantee now, it's district councils that are benefiting from that on that basis. For Wychavon, for instance, it now represents more than 20% of core spending power, so significant amounts of money there. But in terms of actual cash payments, the largest amounts are now going to some upper tier authorities. Surrey County Council getting the largest individual cash payment, over £6 billion. Some other issues, I won't touch on these too much. A few to pick out though is we're still expecting an announcement on the surplus from the levy account in respect of, well, in the 24-25 final settlement. I think it's in respect of 23-24. So keep your eye out for that. I think it should be at least at the level that we got in the last final settlement. So at least I think it was £100 million was distributed in that year. So I think we're looking at something similar. Household Support Fund. For some authorities, this has become a really important part of their budget and what they use to support their residents. Very mixed messages from ministers about whether that's going to go ahead or not. My guess is that we'll get some announcement in the March budget, but we just don't know. I've had quite a lot of questions as well about the homelessness grants and the allocations for those grants. These are always hard to track down and work out what the heck's going to go on from officials, but we wait for announcements on the homelessness grants that were announced as well. It's worth looking at the simplified funding landscape for local government. I think it looks fairly peripheral at the moment. Phase one is really just looking at some of the big funds that are around for economic development, so the Levelling Up Fund, Towns Deals, Future High Streets Fund, that kind of thing, and yet more Pathfinder pilots to see how they can be done more simply. Then establishing a new doctrine for funding that's outside what you really would call core funding. So it doesn't apply to settlement funding, and it doesn't apply to the main funding blocks around funding for schools, funding for social care, police, fire and rescue, and public health. So really, it's looking at a new funding doctrine for fairly peripheral funding streams. But the most interesting part for me is that they're looking at how they were going to handle the new multi-year single department style funding settlements that will be allocated to Greater Manchester and West Midlands as part of their Trailblazer devolution deals. These will be funding allocations that will be announced as part of the spending review for 25-26 onwards. There'll be multi-year, so they should last the full 4 years. So this is going to push the government into doing something quite different and actually giving these two city regions very different sort of funding deals. And I think that will impact on the way the settlements work as well. So there's something interesting to keep an eye on for now. In the short to medium term, it might only really affect those two Trailblazer deals. But I think for the longer term, that's got something that really could help us significantly. Then looking a bit further ahead, the main problem for the public finances is that growth isn't strong enough, and without GDP growth, it's very difficult to increase funding for public services without having to increase taxes at the same time. So the key outlook really is, what do we think, or what does the OBR think growth is going to be in GDP terms over the next 3 or 4 years? They're saying that they think it might get back to its longer term trend rate of about 2%, but recent evidence suggests that it could be quite difficult to get on to that level. And without that level of growth, it's difficult even to sustain the level of funding allocations that the government's indicated in the budget. So that puts a lot of pressure, a lot of risk onto a future government and how it handles the public finances, and for us, for the amount of funding that's available in our settlements. Again, another bit of breaking news. This is from yesterday. Richard Hughes, the chairman of the OBR, was at the Lords Economic Committee. This is reported in the Times this morning. Very critical of the way the government's handling the public finances in terms of there's no real detail about what's happening beyond 2025. He says we know virtually nothing about the plans beyond 2025. It's just two numbers, one for total current spending, one for total capital spending. So really saying it's a work of fiction. Underline that actually the latest public finance bulletin shows that borrowing is actually better than expected, about £5 billion better, which will give the Chancellor a little bit more scope to either cut taxes or find more money for things like social care. So a little bit of brightness on the horizon, but I think the real substantive point here from the OBR is that we just don't know anything about the real plans for the budget for the medium term. So the next budget itself will be on the 6th of March. That's slightly earlier than expected, which some people thought indicated there might be an early general election. It doesn't look like it. I think the real reason is possibly just to give as much time as possible for any tax cuts that are announced to actually be felt in people's pockets. So 6th of March is the next thing we're going to be looking at. The political focus really has been on whether the Chancellor will make tax cuts, and that's been his preference. When the money has been available in previous fiscal events, he's used that for tax cuts rather than for spending increases. But as we've seen, there's continued pressure on public services and continued pressure for additional funding, not least from our own sector. So I think we should see some of that money now going into local government. And actually what's happened is in the past is what the Chancellor's done is he's used the increase in tax revenues that have been caused by inflation to fund tax rate cuts at the expense of real terms cuts in public spending. So public spending allocations are made in cash terms. If inflation's higher than what was anticipated at the time, then what we end up with end up suffering real terms cuts in public spending. I'll just skate over to CPI. That started to look a bit better than it was, but looking further forward, it's trying to work out from 25-26 onwards, and for the next spending review, what level of public spending cuts there will be for unprotected budgets, unprotected services, and that includes local government. The IFS very helpfully publish a regular kind of like ready reckoner for what they think will happen to unprotected budgets in the next spending round. Their headline figure is a 1.8% real terms cut in unprotected budgets. Although actually if you factor in post Barnett consequentials, that actually goes down to a 3.4% real terms cut in funding. But even if we go with a 1.8% real terms cut for unprotected budgets, that if inflation's around 2%, is effectively a cash flat settlement for unprotected services. A couple of comments on that. One is that's very tight. So if a future government does stick to that, that means really big overall cuts in funding for unprotected services. It's pretty much going back to what austerity looked like in the 2010s. Lots of commentators saying that's implausible. Local government saw larger than average cuts in funding during austerity because it was able to raise its own revenue from council tax, and that is an ongoing risk for the sector, that in terms of grants we do less well than even unprotected budgets. But that hasn't worked out particularly well for the sector, and for some really important services like social care and for homelessness, governments had to put a lot more money back into those services to stop them falling over. So I think some parts of the sector will, I think, receive more protection, social care being a key part of that. So future local government prospects are less good than they were. Our modelling, we're assuming that core spending power is dropping from about 6.5% this year down to about 4 or 4.5% from 25-26 onwards. But much of that depends on council tax increases being around 5% into the future, or that 3+2 metric that we talked about a few slides ago. We're assuming a cash flat increase in SFA rather. So even if CPI remains at 2%, we're assuming that we're looking at real terms cuts in settlement funding assessment of around 2% per year, so cash flat for SFA. For social care, we're assuming a £500 million increase per year, so somewhere between 300 million and 1 billion is probably the right sort of range, but our default setting is for £500 million per year, and then no change in other funding streams. So with council tax increases, we're still possibly looking at resources going up by more than it's in real terms, but only marginally so. But given the pressure on your budgets, that turns into severe budget pressures. Core spending power increases in the future won't be as good as they have been, even if we may just touch into marginally into real terms increases. I think we're looking at a rollover settlement in 25-26 and then possible funding reforms in 2026-27. So a lot of uncertainty, a lot to play for, a lot to keep an eye on over the next few weeks, and then into March in the budget, and over the next year as we get more political upheaval and turmoil. So Martin and Jamie, that's me done for that and my presentation.
Adrian, thanks very much for that, and obviously highlighting a number of key issues and just the general uncertainty moving forward. And see, even as we speak, it looks like there's 24-25 settlement figures, at least in terms of social care grants and support, like to be changed. But I'm assuming, obviously, while we're expecting this written ministerial statement today, that presumably is just going to be updating on this additional 500 million expected for social care, and also the increase in the funding guarantee for districts from 3 to 4%. But we're not expecting the final local government settlement, as far as I'm aware, today. I'm assuming that's still going to be the week after next, unless you've heard otherwise. So.
No, I mean it's interesting seeing the comments coming through. Things are happening as we're doing the presentations. Really, it's interesting from Claire Smith saying about SOGOMA have announced that we're expecting an approximately £500 million additional funding for social care today, an update in the Commons today, and potentially the funding guarantee increasing from 3% to 4%. So we'll keep an eye on that today and issue some updates later on if anything comes out, which looks like it will, and change the model too. Exciting times, Martin.
Yeah, I think it's just sort of the difficulty of planning ahead, as you've highlighted, given the general election, which we're assuming now will be October, November. I mean, in theory, it could run up to, January 2025, almost 12 months away, but I think that's unlikely because they're unlikely to want to have a general election campaign over Christmas and New Year. But obviously, we'll have to see how things go. But clearly, that's going to impact on the local government settlement. We're assuming whatever the outcome of the election, as you said, there almost certainly will have to be a roll forward, because there's not going to be any time, if there was a change of government, change of controlling party, for them to introduce fundamental changes. I mean, clearly the last equivalent, I suppose, was 2010-11. I mean, clearly that was more challenging because they were coming on, we had a new government coming in the midst of a financial crisis due to the ongoing impacts of sort of 2008 financial crash, but they still maintain the 2010-11 settlement figures. They did make some changes to specific grants, but I think the core settlement wasn't amended, so we would assume that this will carry forward, and if they're going to provide additional funding, if they wish to, they do that via specific grants outside the settlement. So I think we've had a question from Liam, which will pick up these in, of course, how others are treating the social care grant from 25-26. Assumed additional funding would fall out, but are they being overly prudent? You know, so I suppose I'm aware there's issues around the distribution of it and the sort of funding formally used and the split between sort of adult social care and children's services, which obviously affects different authorities in different parts of the country, depending on the makeup of their local population. So I'm not sure if you had any thoughts on that, really, apart from we probably just don't know, but we're assuming it'll be a roll forward again.
Yeah, I mean, that was certainly what we're assuming in our modelling, Martin. I mean, I'm interested to see what Mike's got to say about this, about whether the LGA are assuming that rolls forward as well. I just can't see a world in which that funding, potentially, a couple of £1 billion worth of social care funding is removed from the sector. It's struggling enough as it is, and I just can't see a future government taking that risk. It would be a huge risk. I think my view is it's baseline. It would be interested to see whether there are any or many other authorities that are doing what Liam's doing at KNC. It's always better to be part of a group, be part in the pack rather than to be an outlier. So if anyone is doing something different from Liam or doing the same as Liam at KNC, I'd be very interested.
Okay, thanks very much. So I wasn't sure if there's any other questions anyone have. I don't see anything else in the chat, and clearly we'll wait to see what the written ministerial statement says this afternoon, whether it'll just cover those two items on social care and the funding guarantee for districts, or whether there'll be any other announcements. Because clearly, I'm assuming there's other outstanding issues. New homes bonus, the household support fund carries on, assuming that ends. So there's various things that still need to be clarified one way or the other. But that's obviously another key challenge for local authorities in this cost of living crisis, that you've had this significant funding stream that's going to potentially disappear on the 31st of March, and what that means for the various programmes that's supporting. So I think we'll just have to wait and see what further announcements are made this afternoon. I'm not expecting any money for the GLA, Greater London Authority, but you never know. So because we do have a slight gap on the Metropolitan Police budget, so if I've got time to speak to the Home Secretary before they do the written ministerial statement, that might be helpful. Yeah. Okay, so thanks very much, Adrian. So we've now got a 5-minute break scheduled. So I suggest we start again about 22 minutes past, and then I'll hand over to the next presenter for an update on, the business rates retention angle of things and maximising your business rates income and the valuation list. So I'll see you in about 5 minutes time. Okay, thanks.
Martin, thank you.
Okay, so welcome back, everybody. I'm now going to hand over for the third presentation to Simon Horsington from Rates Plus, who's going to cover business rates retention and council tax base building. So I'll hand over to you, Simon. Presumably you're okay to set up your slides, are you, or do you need assistance from Jamie on that? So
hopefully if this loads right, just give me a moment. So can you all see that?
yeah, I can see it, yeah, so just maximize it and then we can work it through, but I think it's all in large font anyway, so it should be okay.
Yeah,
so
let's just pop it in the
slideshow format. Yeah,
there we go. Is that all right, Martin?
okay, that's great. Yeah, I can see that, so I'll hand over to you now. So this should be about 20-25 minutes, and then we'll pick up with Mike Heiser and then the final Q&A session. Okay, so over to you, Simon.
Thank you, Martin. So good morning. Thank you very much for the opportunity to present to you this morning. I guess the important thing to say is, having listened to all of the difficulties which I think we face over the next few years, I've hopefully got a couple of pieces of information about where you might want to look for some money over the next couple of years. So having said that, the sort of approach that I've got in mind for the next 20-25 minutes is looking at tax base building for business rates. We've also got something brand new that we've been working on in London on council tax, which I'll come on to. Not quite finished yet, but will be over the next three to 4 months. Losses on appeals is going to come just next. I'm not spending anywhere near as long as Lee on that, but just a couple of pointers for those of you who are perhaps struggling with the quality of data, which is the Valuation Office check challenge appeal. Some interesting news on completion notices. I appreciate that many people on the call will be in the nature of finance specialists, so this will be in the nature of giving you some stuff that you may not immediately understand, but which you'll be able to pass on to revenues colleagues, and if I've got my information right, it'll probably cause them to be screaming about how I'm completely wrong. But anyway, and then a few comments on how we can sometimes help with complex case support as well. So moving swiftly on for losses on appeals, and I suppose I should have said really on the first bullet point for this slide, having listened to what Lee said in some detail about the national profiling, which they're clearly using. For those of you using the VOA check challenge appeal data, which kind of continues to be clunky at best, I suppose, but for those of you using the check challenge appeal data, I think a couple of pointers really. You will know that the VOA loves to include negative appeals as a consequence of the VO increasing the assessment based on a check made by a ratepayer. We tend to rule all of those out. The VOA tends to include them still. It's a matter of local preference, of course. And then perhaps more significantly, there are some examples still of what in the past I've called phantom appeals, typically at Sainsbury's superstores. I've just included a quick example there of one anonymised appeal. This is how these will present within your own check challenge data. So effectively, on the face of things here, there's a Sainsbury's assessment which is shown under the CCA data, rateable value, host rateable value of nearly 2.5 million RV, and following a successful check, the VOA purports to suggest that it's been reduced to 47,000. A notional check against your rate records will, of course, conclude that it's been nowhere near that quantum of reduction. It will usually be somewhere around a couple of 100,000 or something similar. So effectively, this is an example of where the VOA have attached the wrong outcome at a Sainsbury's superstore site. Sainsbury's superstore site. The effect of which is that if you don't take account of it, you can massively over provide for your charges against the losses on appeals. So it's worth keeping an eye out for these adjustments. They're pretty easy to spot just by looking at the quantum of reduction which the VOA data claims. And then just one final point, which I was reminded of in the last couple of months when we made the mistake again of asking the VOA what we thought to be a very sensible question with regard to a particular client. The VOA tends to be pretty unhelpful, I'm afraid, with any further inquiry on the CCA data. We had an example of a site where there'd been some fairly major changes at a otherwise new shopping centre, which the VOA had clearly felt it had massively overvalued when it stuck it in on the 2017 list. But there were significant differences on the nature of reductions that were being awarded between, on the one hand, significant anchor stores at the site, some of them up towards 50%, and otherwise smaller restaurant concessions, even so still coming at 20%, but significantly less than the 50 at the anchor sites. And we simply asked the VOA if they'd be prepared to confirm what sort of reductions they were looking at awarding across the different classes of hereditament, and the response we got was entirely in the nature of clear off, we've given you the CCA data, that's enough, which is kind of unhelpful. I can't see that we were asking them anything that would have been significantly any skin off their nose, but I think, you know, just be ready for the fact that what would appear to be on the face of things entirely reasonable questions of the VO will sometimes not be considered that favourably. So moving on to tax-based building for business rates, which is kind of my first significant area in which to look for additional revenues. I've got some nice pictures to make the point of stuff that I think can be successfully tackled. So the first of those is here. For those of you with any familiarity with South London, here is a Google Maps picture of the IMAX cinema just on the South Bank. The face of the building is covered in a large digital advertising right, which you can see there advertising Marc Jacobs, perfumer and designer or whatever he is. But in any event, the advertising right, a digital advertising right, clearly covers the whole of the building and is described by the owner of the advertising right, which is Ocean Digital, Ocean Outdoor, one of the two, as the largest digital advertising canvas in Europe. And it's not in the rating list. Our client here is London Borough of Lambeth. We spotted this for them early last summer. The cinema is rated at a rateable value of just over $500,000. Now, significantly, if this is indeed the largest digital advertising canvas in Europe, the second largest digital advertising canvas in Europe is the banner advertising in Piccadilly Circus, which is in the rating list at about 9.5 million RV. So potentially we're talking about a pretty significant omission from the rating list here. We estimated last summer somewhere between 5 and 9 million RV. It's difficult to be exact with assessments of this type. One of the things we try and do, we think rightly, but it does come with its own difficulties. We try and concentrate on stuff that's large value in the occupation of ratepayers who can afford to pay. And in so doing, at the risk of stating the obvious, it means there's nearly always, or if not indeed always, very highly skilled agents, the other side of the fence, who are acting for the ratepayer. So in a case like this, when one completes a billing authority application to alter the list on behalf of the billing authority, in accordance with VOA rules, that gets submitted to the VOA. And under VOA adopted procedures, they sit there for 90 days doing nothing. That's 90 working days, by the way. So we're talking 4.5 months. And at the expiry of 4.5 months, you write to the VOA. Probably you write to them on behalf of ourselves as the supplier, and you also get the billing authority to do it, because the VOA sometimes don't respond to external agents like me, as was the case here. So we then got a very quick response back to London Borough of Lambeth from the VOA saying, oh, we've looked at it and it's not rateable, so we've now actioned it. Now, clearly, with a rateable value of this sort of quantum, that was not acceptable to the local authority. So at that point, we escalated. Getting meaningful information out of the VOA is extremely difficult. We got a bit lucky with one of the escalations we tried. One of the senior officers in the London VOA, based out of Canary Wharf, who we contacted to complain, wrote back saying, yeah, we see you've got a point there. If nothing else, the value isn't reflected anywhere. Leave it with me. So that's kind of where we've got to at about Christmas last year. And the guy who's looking at it, in fairness, is a skilled, experienced valuer who's doing his best within the current disaster zone, which is the VOA under the HMRC control. And I'd be hopeful that we see something coming into the list on this at some point this quarter. Clearly well outside of the 90-day target claimed by the VOA, but so that's the first example we've got of high value properties which can be hiding in plain sight, basically. I mean, you know, it's there for everybody to see, but it's clearly not rated at the moment. The next example we've got, some of you may have seen this picture before. It's an old picture of mine, showing a couple of multi-storey offices in the Thames Valley. It's just on the outskirts of Bracknell, actually. So these were built physically in about 2012 and were kept out of the rating list until somewhere around about 2017, where, acting on behalf of the authority, we happened to be doing a drive-by with the local inspector and kind of pointed at them and said, so what about them then? Oh, that's the Maxis buildings, they're not in the rating list. And clearly they should have been. They'd been kept out of the rating list because of some agent creativity around the administration of the developer. So we acted with the local authority to make the necessary applications to put them back into the list. I would stress that we did not do this on contingent fee. We did it on fixed fee, because the quantum of RV at stake was in the nature of 2.5 million RV. Clearly, if we'd done that on contingent fee, the fee to the authority would have been eye-watering. So for the matter of a fairly modest set of fees managing the completion notice in, we did get those units added to the rating list from somewhere around 2017. This one we didn't win. Again, this is a very old picture. It demonstrates what can happen when you've got skilled, experienced, aggressive, fee incentivized agents on the other side of the fence. Now, fundamental to this problem, top picture is a standard library picture. The bottom picture is one of mine, which I took on site. So red ring around the bottom 5 floors at the site of 1 Canada Square. Now, clearly, as you'll observe, this is a standard building in which there doesn't appear to be a giant hole in the bottom 5 floors of the building. But those bottom 5 floors are absolutely not in the rating list. So that's ground floor, first floor, second floor, third, fourth, fifth. The rating list starts at floor 6, at which time the substantive footprint of somewhere around about 1.5 million RV per floor kicks in. So we're talking about a £5 million avoidance at this site, which continues to this day. Fundamentally, how have the agents been able to take this forward? Answer: the billing authority has no right of inspection, and most of the decent agents know this. So this site, having agreed with the billing authority, London Borough of Tower Hamlets, that we would make a right nuisance of ourselves about 7 years ago and present at the site and ask to be shown upstairs, having that failed, I have to tell you, and having been detained by security for 40 minutes while they worked out what to do with me, the agents for the ratepayer were crystal clear that the billing authority had no right of inspection. So that whether that was the inspector for the authority or me, nobody was getting upstairs to inspect exactly what was going on those floors above the ground floor. And that continues to this day. Sometimes the agents who are extremely aware of what their rights are, incentivized by percentage fees on, as I can say there, 5 million RV, which has continued to be protected from the local taxation system. I'm afraid that sort of shenanigans does continue. So as I've kind of mentioned, the sort of wrap up on business rates is we absolutely, unlike some others in the sector, we absolutely will focus on higher value premises in the occupation of ratepayers with the ability to pay. We operate on contingent fee service like most of the rest of the sector, but importantly for those units which are known to be higher value and for annual work streams which are higher value, we absolutely will agree capped fees at the outset, and we will take the lead on that to help councils think about what is likely to be fair and appropriate at the back end of things if things like that bloody great ad right at the IMAX are actually brought across the line. So we will do that. We will keep the fees safe for everybody. We absolutely do not report billing authority premises which may be undervalued, and we absolutely will work around your existing inspectors, including particularly avoiding looking at current planning records and similar, which are likely to be the bread and butter for your current inspection team. So that's business rates. I wouldn't like anybody on the call thinking there's an IMAX ad right in everybody's area. There's not, but it does illustrate the extent to which higher value properties can often be missing in plain sight. And although, you know, units of 9 million RV are unusual, clearly they are on their own, units including pretty significant offices and or pretty significant units on retail park are not unusual and are present pretty much all over the country. So council tax, this is the bit that's brand new this year. I've also included a dreadful graph. My apologies, graphs not being my strongest suit. So this is to do with council tax exemptions. I've shown a summary here from the completed CTB forms of the exemption awards in London, excluding classes A and C. The 33 London boroughs are the blue lines you see there. I've anonymised them. So basically you can see from that slide that of the 33 London boroughs awarding exemptions in council tax, the average, I should tell you, is published by the ministry is 2.9% of tax base. You can see that about a third of London is above that. We've got a clutch of authorities, 4 of them around about the 5% mark. Exemptions under council tax have increased significantly since COVID. And indeed, if we look back at the CTB returns over the years, since 2013, the average across the country has increased from 2.1% to 2.9% currently. And we have just a few examples outside of London where currently exemptions to tax base on council tax are over, which looks pretty eye-watering to me, but anyway, are over 10%. So what's this about? And the answer is we think it's to do with particular classes of council tax exemption which perhaps haven't been reviewed as work pressures have meant that councils' revenues teams have been focusing on the latest ministry grant scheme or similar. So what we're doing in London with the support, it has to be said, of the GLA and with 3 other London Borough councils, is we're looking at targeting those exemption classes which are semi-permanent and which have not often been reviewed. And this focuses on, in our experience, severely mentally impaired students, premises last occupied by people in care, and also properties protected by a probate exemption, all of which will continue ad infinitum unless anybody reviews them. So that's under a review at the moment. The pilot is progressing at the moment. We've got 3 London boroughs who are participating with us, together with the support of the GLA. We've started with 1 London borough, which is London Borough of Harrow. That data processing is largely complete, and the inspection and further context phase begins now. We expect to be finished at Harrow perhaps as early as March. And even although Harrow are well below the 2.9% average, they're around about the 1.7. It certainly looks like there's still stuff to investigate there. So I'm quite hopeful for this in terms of giving us a useful basis to build tax base and council tax from later on this year. We're not aware of anybody else who's completing this research at the moment, and despite a couple of claims from some of the others suppliers who do things like single person's discount that they do this, I don't think they do. So I think we're genuinely going to be out there with something brand new with this from later on in the early spring of 2024. Other matters, so completion notices. This is technical, but it's worth taking account of, because like a lot of other things the VOA do, they've published a item in their newsletter which you kind of might not necessarily look at that hard, and it's kind of fundamentally changed the rules in local government's favour for a pleasant change. So to start with, and I appreciate the complete bizarre nature of this, following a case in 2018, the Leicester City and Delft Properties case, the completely farcical situation in which we were left, this was a VOA appeal, was that properties which had been removed from the list because of works could not be subject to completion notices because they were not considered a new building within the meaning of Schedule 4 of the 88 Act. Incredibly clever argument on behalf of the ratepayer, probably completely duff defence of that by the VOA. Either way round, we ended up in this completely farcical situation where sometimes properties which were subject to major refurbs could be taken out of the rating list, and then the building authority couldn't bring them in. They served a completion notice and the VO said, well, it's not a new building, so we're not acting on it. Your revenues people would then go, so what, do we wait until it's occupied? And the VO would go, yeah. So potentially lost revenue for years until the darn thing gets reoccupied. This situation has been corrected within amendments that have been made within the Non-Domestic Rating Act last year. So effectively, your revenues teams can now serve completion notices on the premises that I've just described. So in the past, if they've been frustrated since 2018 with major refurbs in your areas, which under post-COVID environments might not yet be occupied, this act changes the game. You are now allowed to serve a completion notice post 26th of December. They should be cracking on. Now, bearing in mind some of the skill sets that are out there in the local government inspection teams, your inspectors may need some encouragement to get on with it, but you should encourage them so to do. Completion notices can now be served. The Act is there. The advice in VOA Practice Note 18 or whatever it is pretty clear, and for a change from the VOA, very easy to read. So direct them to that and tell them to get on with it. We can also help with complex case management. Sometimes agents can be extremely tenacious, pushing things to the VT that are pretty much baseless, and we can help with that. We'll always do that on a fixed fee. Casework, preparation of papers and attendance at court is all included, all of which can be extremely hard for the revenues team when you're arguing with an agent who this is their bread and butter. And in a recent case that we acted on in the Thames Valley, where there were more than 200 domestic completion notices with regard to a high-end conversion of a property, we ended up getting the agent case dismissed. We charged only 7,500 plus VAT. Clearly 212 units were then added to the local list with sort of band C and band D and above premises, so significant tax base gain from that exercise. We'll always do that on fixed fee. Contingent fee is just far too risky for that sort of exercise. We also managed to get a good result in London a couple of years ago for central list protection. This is an old case study, but it's so significant that it's just worth mentioning again. And essentially, after a lot of sparring over many years with the ministry, we did manage to protect losses to the central list from telephony, which had been tabled, protecting in particular the radio masts. That would not have been possible without the cooperation of the GLA and a small number of other local authorities in London. But as a consequence, we've saved at least 100 million RV in London. Consequential benefits to the rest of the country as well, of course. So just as I come to a close here, hopefully reasonably close to 25 minutes, there's a little picture of some of the clients in London and the Thames Valley. That continues to be where we're looking to build base. So thank you very much. That's me, Martin. Back to you.
Okay, thanks very much, Simon. So I think it's a very helpful update there, because clearly, you know, there's obviously a focus in Adrian's presentation about maximising funding from, you know, the government, but I think there's obviously an important role that local authorities can play in terms of maximising the tax base, whether that's employing additional property inspectors to inspect properties or using third-party contractors such as Rates Plus, Analyse Local, other providers that may be available, just to make sure that you are identifying everything that should be on the rating list and everything's properly valued, and obviously, you know, as well in terms of ensuring that rates reliefs are being properly collected and enforcing subsidy rules, etc., etc. And obviously on the council tax base building, I think that's an important piece of work in terms of just maximising that key source of income for all local authorities. Obviously, if there's any questions you have for Simon, then please feel free to put them in the chat or contact him separately. And similarly with the previous presentations, to contact Pixel and LG Futures if you have any questions about their presentations, because we will obviously also be circling those afterwards as well, so to everyone, so you can review those and you can either come back to Jamie and me if you've got any questions, or you can raise them directly. So in the absence of any questions, then assuming, just checking, Mike Heiser is still on the call. Can't see him, but if you are, Mike, if you're able to join and do your presentation for about 10 minutes. If not, then we'll move on to the Q&A session. Yeah, I noticed that Mike has put.
No, Mike is still there.
Oh, sorry. I couldn't see him on the presenters list. That was all. Apologies. Slight hiatus, but we're worried you might have been pulled away because of the announcement today. But more details, but you probably can't say anything at this stage, so that's fair enough. So can I hand over to Mike for his update?
Good morning, everybody. Yes, as people say, it's seems to be quite a busy morning and might be quite a busy afternoon. So no, I can't say anything more than has now been reported, other than we are expecting a written ministerial statement this afternoon. And, you know, obviously LGC must have been briefed on good sources, but we'll wait to see exactly what the ministerial statement says. And I don't think that means, I would be extremely surprised if that meant the actual announcement publication of the final local government settlement. I think we're still probably expecting that at the start of February, on the sort of timeline that Adrian was talking about. So I have put the link to the LGA submission on the local government finance settlement in the chat, and perhaps I'll just sort of run through our responses to the questions. But overwhelmingly, our leading members from all parties were disappointed that there was no more money other than that already signalled in the provisional local government finance settlement. And we are pointing to the funding gap of 4 billion across this year and next. So People have talked about the proposed methodology for the distribution of RSG, and with that also how they have allocated the increase in SFA and multiplier under indexation grant. It does seem that as colleagues have said, taken together, these amount to CPI, but I'm interested in the calculations that LGF and others have done, and happy to be part of any conversation with DLUC if they feel that anything needs revising. On the other slightly complicating feature, at least for authorities with fire responsibilities, was the decision to consolidate the Home Office's fire and pension grant. That is something that we welcome, but we have called on the government to publish the precise calculations to show how the adjustment to SFA has been made. And we've also, because obviously once a grant is put into the settlement, any particular pressures won't be taken into account. So although we agree with consolidating the grant in principle, we call for the government to keep pressures on fire pensions, for example, those from the discriminatory practices in the firefighters pension scheme, under review. On council tax referendum principles, we do point to the fact that because the adult social care precept is calculated based on the council tax of single tier and county councils, that means that in two-tier areas the amount to address social care is lower because it excludes the council tax to fund Shire district services. When we put our draft response for clearance through members, they felt that this is becoming an anomaly, and we are calling for councils to be able to raise the ASC precept on both the Shire County and Shire district element of council tax in two-tier areas. As has been said before, we agree with the call for Shire districts to be given the limit of £10, and also call for standalone fire and rescue authorities to be given the £5 flexibility, as was the case in 23-24. On the funding guarantee, the new homes bonus and the services grant, to an extent these have to be taken together, because the fact that the services grant went down so much, and there was concern in the sector that because it significantly reduced from its 2023-4 level, that consideration should be given to the impact of this reduction on individual councils, some of which were surprised at the scale of the reduction. So they obviously used the funding guarantee, which is they use the same methodology as last year. So any increase in additional resources is likely to maybe reduce the funding guarantee, which seems to suggest that one of the way to get out of this will be to put the current funding guarantee up. But as I say, we'll have to see exactly what the written ministerial statement says. Funding for social care, we don't take a formal view on this distribution, but we do note that relative needs formulae are now out of date, and the formula was developed some years before 2013-14. Yes, I mean, obviously, I think a lot of councils are now considering the amounts to be baselined, and so unless they did some really tricksy stuff with showing increases from year to year on a baseline that didn't include the additional social care grants. You would be showing substantial decreases if you take the social care grants out. With New Homes Bonus, because it's just the 1 year grant now, there are substantial movements in both ways, and those have been protected by the funding guarantee. But of course, that means that the increases aren't allowed so much to come through. One thing that people haven't talked about is the so-called 4-day working week and equivalent, and the government sort of threat of using levers in future local government finance settlements to disincentivize this. So we did say that councils are experiencing staff recruitment and retention difficulties, and they should be free to pilot innovative solutions to address local challenges. And it should be local voters who should be the ones making a judgment. So quickly, Adrian's already mentioned the levy account. We did point to the fact, firstly, that the draft local government finance report said that if there was to be a credit to the levy account in respect for 24-25, in other words, a top slice, that would be decided at the final settlement. But we also note that 100 million of levy surplus was distributed in the 23-24 final settlement. And as I think I've said at the Collection Fund Network before, according to the levy account of 22-23, there's a closing balance of 220 million. So we'll have to see if any balances on the levy account are distributed to councils. But of course, that isn't within core spending power. We've welcomed the confirmation of the statutory override for the DSG until 31st of March 2026, but we're calling for a long-term solution and call for the government to write off all high needs deficits as a matter of urgency. We're also calling for the government to publish the final figures for public health grant. Happy to answer any questions or deal with any other points. I ought to say, just following on Simon on tax-based building, some councils are looking to use the changed rules on exemptions and second homes. Obviously, the second homes can't come in until 25-26, but the government hasn't yet come out with their response to the consultation on exemptions to those rules. So that's something that we're going to be looking at quite carefully and pressing. Thanks.
Very much, Mike. Apologies, there's a bit of noise in the background, so if you can quickly unmute. So I wasn't sure if there's any questions that anyone had for Mike to put in the chat, or whether there's one for Simon, which I'll go back to afterwards. But is there any questions anyone has around Mike's statement or the LGA response? Yeah, I just had a quick one relating to rolled in funding. So I do note that you highlighted the fire pensions grant had been rolled in, and in the police settlement, the police pension grant was more than doubled. I think it went up 130%, but the fire pensions grant, which has been rolled in, has been frozen at 23-24 levels, which did seem a little inconsistent to us. And I think that's part of the risk of rolling in funding, but I accept that, you know, future settlements, it ought to be increased in line with CPI, but it's slightly unfortunate that funding didn't benefit from the wider 6.6% CPI uplift for RSG, but I think it's just one of those things, but it's obviously something to watch out for. Okay, so if we go back to, I think there's a quick question raised around from Sean Knight around ongoing exemptions for severely mentally impaired households, student and class F, which obviously, as we've highlighted, is relating to properties subject to probate, and obviously recognising the current significant delays. So it's whether you had any comments on that particular issue, Simon, that Sean raised at 11:52.
So thanks, Martin. So the answer is it starts with data comparison and credit checks, but that's not where it finishes. The pilot that we've set up with the 4 authorities in London has planned to start with an Experian data check, which looks at who's in the household rather than whether or not they're severely mentally impaired. I can't conceive how you would try and do the latter, but anyway. So we start with a data check and we then move to, which is the point we're just coming into at the moment with the Harrow pilot, we move to further evidence gathering and use of things like site visits, which of course the traditional providers to things like the single person's discount services typically don't get much beyond data comparisons and credit checks, and again that doesn't seem to me to be a good model for this type of activity, where of course if you think about things like severe mental impairment, there's a significant amount of sensitivity around the caseload. The last thing you want to be doing is removing awards that are potentially underlying accurate simply because you've got the wrong names on the register. So in short, it's not just about credit checks, it's about making sure that what's going on the ground is accurate, and we should know a lot more about how that's working in practice over the next 8 weeks, and as we've kind of knocked doors in Harrow and find out what works and what does not. I hope that helps.
Okay, thanks very much, Simon. So any other questions or issues anyone wants to raise for the speakers we've had so far?
I just had one question actually, Martin,
Yeah.
for
Okay.
Mike, really. It was sort of looking a bit further ahead, and it was just intriguing about what would happen with Greater Manchester and West Midlands with their Trailblazer deals and the multi-year single settlement arrangements. Is that something that's been done by those two devolution areas, or is that something that the LGA is involved in? Any idea about how that process works? It could be quite consequential, couldn't it?
Yes, it could be. I haven't been directly involved. I don't think other colleagues have been involved, so it's likely something that's been done directly with the authorities and the department. I mean, we have just put in a submission on the spring statement. I'm hoping that it will go up on our website today. We will have to see what gets announced, if anything, in the spring statement.
Yeah.
Clearly, probably agreeing with you, Adrian. The later that the election is delayed, the more, and that was the sort of mood music that we were getting from people we were sort of talking to in our local government finance conference, the more people will sort of start to tear their hair out that absolutely nothing has been announced for 25-26, either in local government, but of course we do know that civil servants are now all doing their sort of work on the on 25-26 and later, so there's a sort of hidden spending review process going on, but it hasn't actually been made public yet. So you know, whether the government decide to do a 1-year spending review just to sort of, you know, put the civil service out of its misery, well, that remains to be seen, really.
Yeah, that'd be handy if that was the case. Yeah, thanks, Mike.
Yeah, I think that's obviously a very valid point, Adrian, around these growth deals that have been agreed for those two areas. I mean, clearly we also have Freeport's designated areas, enterprise zones, where you have business rates growth retained for periods of up to 25 years, which could easily run into the 2040s in some case, in terms of if a future government wanted to unwind business rates retention, how those areas would be treated. I presume they just have to carry on scoped outside the system, but obviously we can't really prejudge what the next government might want to do around all of that.
Yeah, I mean, obviously, funnily enough, I was looking at the consultation on the original TIF proposals back in 2011 because someone asked a question, and the government was then sort of highlighting what the sort of advantages of allowing business rates retention for TIFs to sort of go across reset periods. And I think what they finally decided on enterprise zones, which is a model that they've kept for free ports, is that they will be allowed to go across reset periods. But of course, we haven't had a reset yet, so
no, it may not get one.
Yeah, because obviously we have a £1 billion worth of borrowing linked to one of our designated areas, so it's nice to have some clarity around that. Because, and obviously we have the differential treatment for the multiplier cap compensation for pre-April 24 and post-April 2024 designated areas, enterprise zones, free ports, or investment zones, or growth zones. They have many multiple names now, depending on the arrangements that are in place at that particular time. So obviously we normally have a quick catch up on emerging issues, but I'm conscious we're way past noon at this stage, so I don't propose to hold that at this stage. I think our intention is to hold a further session probably in March or April, just prior to the NNDR3 submission, just to run through any close down and accounting issues. And again, unless there's any issues or anyone wants to raise around council tax base setting or their NNDR1 returns, if they're likely to experience delays in submitting them, you know, due to software issues because of the impact of the changes, or fingers crossed. Well, we're aware of 2 London boroughs where it might be a bit late, but hopefully everyone else is on time to submit for next Wednesday. Obviously, just making the point for preceptors, it's useful to keep us all updated, you know, given the impact on our budgets as well. So I think in the absence of any further questions, I'd just like to thank you all for attending today. I hope you found the session useful, and obviously thanks to all our speakers as well for taking the time out to join the event. We will circulate all the presentations afterwards, including Mike's link to the LGA settlement response, and we look forward to seeing you at the next meeting, either in March or April. So thanks again for joining, and hope you have an enjoyable afternoon. Okay.
thank you very much.
Okay, thanks. Bye-bye.
Thanks all. Bye. Bye-bye.